The Trump administration has a proposed plan in place. The ultimate goal of this plan is suggested to be more than just engaging in a trade war. It may involve reshaping the entire global trade system. Some speculate that Trump aims to weaken the US dollar. Why would the US intentionally devalue its own currency? Hello, welcome to Stewardship Finance Academy. Today, we're going to discuss a topic that could theoretically change the global economic order and possibly alter your approach to future investments: the Mar-a-Lago Agreement. Over the past 50 years, three major events are often cited as reshaping the world's economic landscape. The first was the collapse of the Bretton Woods Agreement in 1971, which removed the dollar's link to gold, allowing the dollar to dominate globally. The second was the Plaza Accord in 1985, which reportedly thrust Japan into 30 years of economic stagnation. And the third might be happening now: the potential Mar-a-Lago Agreement, which is rumored to be planned by Trump. Before we dive deeper, if you're finding this information useful, don't forget to hit the like button to save this video for future reference. Your support helps us bring more content like this to you. Why could this agreement, following the Plaza Accord, hypothetically become another upheaval in global political and economic order? How might it affect our wallets and the future of our investments? Let's explore the possibilities behind this theory. Since Trump took office, he has reportedly rapidly implemented tariff increases, sometimes followed by trade talks, insults directed at China one day and the EU the next, and even a 25% tariff on all imported cars and car parts. Many have wondered whether he truly wants to wage a trade war, or if this is all just a negotiation tactic. But the reality is that the Trump administration may have a large-scale plan in mind. The goal could be to completely reshape the global trade system. The starting point for this proposed strategy is an article written by Trump's economic advisor, Milan, titled "Reshaping the Global Trade System." In the article, it is argued that the US's long-term trade and fiscal imbalances may have made the current global financial structure unsustainable and in need of fundamental reform. The first step in this reform could involve using tariffs as a powerful negotiating tool to force other countries into new bilateral or unilateral agreements, with the ultimate aim of potentially achieving a weaker dollar policy. The end goal of this strategy may be to restore U.S. dominance in manufacturing. This goal bears resemblance to the Plaza Accord of 1985, when the U.S. allegedly pressured Japan to appreciate the yen, which led to Japan's economic bubble bursting, resulting in a stagnation that lasted decades. Now, Trump may seek to do something similar, but this time not only with Japan, but possibly with China, Europe, and other global currencies. What does Trump allegedly want? In short, he may want to weaken the US dollar. Why? Because with a weaker dollar, US goods could become cheaper, more competitive on the global market, and other countries' goods could become more expensive. Therefore, Americans may be less likely to buy them. This could encourage more companies to move their factories to the US and produce goods on home soil, potentially boosting US manufacturing. On the surface, this strategy appears clever. But here's the question: could it lead to another lost decade globally? Let's take a look at this chart, which shows the proportion of manufacturing in the US economy since World War II. In 1940, manufacturing made up 35% of the economy. But now, it's less than 10%. So who is to blame for this decline? Is it China, Mexico, or is it America itself? Let's turn to an expert for insights. In 2017, Jack Ma at the Davos Forum stated, "It's not other countries stealing American jobs. It's that the US didn't allocate resources effectively." His comment resonated with many. Khan explained that American companies outsourced low-skill, labor-intensive jobs to China and India, while keeping the high-profit jobs in brand management and high-tech research and development. This division reportedly allowed U.S. companies to thrive for decades, creating many of the world's top 100 companies and producing stocks that rose significantly in value. But where did all the money go? Over the past 30 years, the US has launched 13 wars, spending $14.2 trillion. Much of the rest of the funds appears to have flowed into Wall Street. But as the saying goes, don't put all your eggs in one basket. The 2008 financial crisis wiped out $19.2 trillion worldwide, leaving 34 million people unemployed. So if the US has all this money, why don't the American people feel wealthier? If US companies had invested that money in infrastructure or industry, could the US have maintained its manufacturing sector? Trump's administration has identified the same root problems, which is why they're reportedly working to overhaul the US economic structure and global trade system. This plan is called the Mar-a-Lago Agreement. The 5 key points of the agreement are: 1. Use tariffs to pressure other countries to increase investment in the US and reduce the trade deficit. 2. Negotiate for a weaker dollar. If we look at the Plaza Accord in 1985, Japan was forced to appreciate the yen, which led to a 30-year economic slump. Today, the targets could be the yuan, the euro, or other emerging market currencies. 3. Debt restructuring. The US may issue ultra-long-term government bonds to ease fiscal pressure. 4. Establish a sovereign wealth fund like Norway and the Middle East to invest in key US technologies and industries to increase long-term competitiveness. 5. Cut military spending. The US will ask allied nations to share more of the defense burden and reduce military expenditures, focusing instead on economic growth. To achieve these 5 points, Trump has developed a strategy of quick punches and long-term heavy strikes. In the short term, this involves reducing government spending. Over the past 5 years, over half of US GDP growth has been fueled by government spending. But can the US continue to print money indefinitely? Trump may not think so. Therefore, he has set up the Department of Government Efficiency to reduce spending. However, if the government stops injecting money, the economy could slow down, reducing investments and consumer spending, leading to a vicious cycle and a potential recession. The ultimate goal, however, is to shift America's economic model and allow for the return of US manufacturing. In the long term, Trump aims to reshape global economic growth patterns and boosts the US's position in global supply chains. This strategy could result in the collapse of the current global economic framework, triggering political and economic turmoil worldwide. The Mar-a-Lago Agreement is gradually taking shape. If you want to understand how to adapt your investment strategy to this rapidly changing economic landscape, sign up for our free SFA Stock Investment Masterclass. This is an exclusive, limited-time offer, so don't wait. The opportunity to learn these strategies won't be available forever. Click the link in the description to register now. You don't want to miss out on the chance to take control of your financial future. How should you position your investments in the face of this? The answer lies in a systematic investment approach. Over the course of a year, we've created an investment method combining macroeconomic value investing with cyclical and pattern-based investment strategies. By mastering this approach, you can avoid market downturns and strategically invest in assets poised for growth. We also offer additional one-on-one mentoring sessions for students. For more details on how to adapt to these economic shifts and secure your investments, click the link below to sign up for the masterclass now. Don't forget to hit the bell notification so you won't miss any of our latest updates. Stay ahead of the game with us, Stewardship Finance Academy, turning you into a confident investor. Disclaimer: the content above provided for educational purposes only and should not be construed as investment advice. The information presented may contain speculative claims, and we do not guarantee any outcomes. Always consult with a professional financial advisor before making any investment decisions.